Hello and welcome back to the Note, back after a brief break during which things have calmed down considerably. If we take a look at the FTSE All World Index, which covers all the world stock markets, you can see that after briefly being more than 20% below their record from last year, you have seen a very significant rebound. Now, some of that is not surprising. You would expect a bounce back after a fall of the kind of magnitude we saw earlier this year. But there are some good fundamental reasons for a rebound as well. If we take a look at the latest US core inflation numbers that came out today, so this excludes food and excludes the impact of the radical falls in the oil price, you can see that we do seem to be having a very clear pickup in inflation, admittedly still at quite low levels. That's not consistent with the very much prevalent belief, growing belief over the last few weeks, that there's a risk of an imminent US recession. Added to that, this week we've had a recovery of sorts in US industrial production. We've had higher producer price inflation numbers. At the end of last week, we had a better than expected retail sales report, all of which are consistent with the fears of a recession being overdone, but also consistent with the belief that perhaps the Fed might have to raise rates after all. Now that leads to this fascinating move that we've seen in market perception of rates. This is derived by Bloomberg from the Fed funds futures market, and it shows the implied probability that rates will still be where they are now with no rate rises at all after the December meeting of the Federal Reserve. And you can see a really dramatic shift in expectations in the first few weeks of this year to people basically taking it as a racing certainty that there would be no rate hikes at all in 2016, and that has been very significantly pulled back in the last week or so that we're now seeing it as roughly a 50-50 shot. Now, bear in mind that that's still a big disjunction from the Fed, which is still guiding us that there could be as many as 4 rate rises this year, but plainly this does have a big impact. If we are likely to see another big change in rate expectations, that raises the risk of a financial accident in the foreign exchange or bond markets. It also is troublesome for the valuation on stocks. It's good that there is less of a risk of a recession. It's bad for valuations of stocks if that means that rates are going to be higher. Now, we also need to look at the incoming bad news for the stock market. We've now almost completed earnings season for the S&P 500. And as you can see, there's the number for the fourth quarter of 2015. We've had a very significant decline in earnings. And we've also now got expectations of a worse decline in this current quarter and a fourth consecutive quarter of declines in the second quarter. Some kind of a rebound thereafter, but this is obviously a very bearish prognosis, very hard for stock markets to make progress under these conditions. And if we take a look in more detail at what's gone on in the expectations for this current quarter, the first quarter of 2016, it's not just about energy companies for whom estimates are obviously falling. What this shows you what the implicit forecast was for earnings in different sectors going back to April of last year. You can see that the S&P at one point was slated for a 15% growth in earnings, is now down to a 5% decline, and a large chunk of that is technology. We've seen expectations for technology collapse in the last few weeks. When you have numbers like that, when you have a lack of perceived earnings power like that, it's very hard for stock markets to progress, particularly if the risk of higher rates is beginning to be priced back in. So we certainly have calmer conditions. There are perhaps fewer reasons to be concerned about a recession than there were a few weeks ago, but the stock market is not out of the woods.